Good day. It is Taxes and Retirement Live, Wednesday evening, 8 p.m. Eastern. Um, can only mean one thing, Taxes and Retirement Live. Quick update on my weight. So I was up 2 pounds this week. Da-da-da-da. Not surprising. So I'm 172.5 pounds coming off of 170.5 the week before. But the week before, I think I got a weird reading. That was 4 pounds down from the week prior, which couldn't have been right. Or maybe I was really dehydrated or something. So I kind of thought that was a little too low. Plus, last week, I had a few big eating events. Went to a concert, had a big fat sandwich, some chips, may have been a handful of beers. This past Saturday, went to a wedding. And man, watch out. When you put me in front of an all-you-can-eat raw bar, it's about to go down. So I had 30-something oysters, big oysters, as many clams, about a dozen bacon-wrapped scallops. And that was all just the happy hour. Then there was still a meal. And again, may have been a handful of beers. And then Sunday was my daughter's birthday, where we celebrated my daughter's birthday. Went out to an Italian joint, and I wasn't just going to eat salad. So I had some pasta with bolognese sauce, which is super salty. So not surprised. I woke up Monday morning, did my weight, and I was 2 pounds heavier than the week prior, but still not bad. For the 3 weeks total, I'm down 4 pounds, which is where I was tracking to try to be. Figuring a pound and a half a week down is my goal. So I'm still there, and I knew last week was going to be an ugly week, so not surprised. But anyway, that's the weight update. Quick side note: I like American cheese, and I'm not afraid to admit it. My wife, I don't know why I thought about it. Oh, I was eating a piece of cheese earlier today. And my wife does not like American cheese, and she does not like me for liking American cheese. She claims it is not real cheese, which it's not. I know it's processed cheese-like product, but it's my fave. She's a cheese purist, almost a cheese snob, some may say. It's got to be an actual cheese, whereas me, give me American all day long, and I'm plenty happy. So that's that. Dad jokes before we get going. Oh, tonight's topic, super exciting. This may be the nerdiest thing we've hit on yet, capital gains taxation. Got some good stuff for y'all. Some slides and a mock tax return to actually show you this stuff in practice. Dad jokes for the evening. I love the way the Earth rotates. It makes my day because the Earth goes around 24 hours. It rotates on its axis. Someone stole all my lamps. You'd think I'd be upset, but I'm actually delighted. And finally, you got to think about this one. It's a little nerdy. 6 is scared of 7 because 7 ate 9. But why did 7 eat 9? Because you're supposed to eat 3 squared meals a day. Get it? 3 squared meals. 3 squared equals 9. Supposed to eat 9 meals a day. All right, that's enough. What am I doing? This place is going downhill fast. Disclosure before we get into it. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I'm not. I'm some guy telling you about his weight, telling you horrendous jokes, and talking about tonight how capital gains are taxed. Super exciting. Comments are working. Dave Fultz, howdy. Mark Troutman, yes, a member of the Rock Retirement Club, otherwise known as RRC. See you in Fort Worth. So yes, the Rock Retirement Club I've touched on before. It's a pretty cool membership group of people in or near retirement looking to learn, have a sense of community, kick ideas around with one another. The club is doing a rodeo for its members, a weekend-long event at the end of October in Fort Worth. It'll be a better part of a day worth of sort of educational things, of which I will be one of the presenters, and then there will be a rodeo we're going to. My joke is I often like to say when I do something that this isn't my first rodeo. Well, guess what? This rodeo actually is my first rodeo. So I've never been to a rodeo. Okay, let's get into it. So capital gain taxation. Feel free to post comments, questions. We'll get to them. I'll probably just kind of march through my stuff here like normal and then handle all the questions at the end. One other thing to keep in mind, what I'm talking about tonight will all be federal, the federal tax treatment of capital gains. Keep in mind, state taxes, like anything we discuss in this group, state taxes, it's always its own animal, separate and distinct from the federal tax of what we're discussing. Now, in my experience, I've probably worked on a dozen different state tax returns, a little more maybe. Generally, from what I've seen, states do not give any sort of preferential tax treatment towards long-term capital gains. They treat it as any other source of income and apply whatever your state income tax rate is. Some states are even pretty punitive in that they don't give you like a deduction for losses. So as we'll touch on federally, you can deduct up to $3,000 of net losses against other income. New Jersey, where I live, for example, they don't honor that. If you have a net loss on security sales, for example, it's gone. You get no benefit from that at the state level. There's no carryover. It's just it's gone. New Jersey's kind of jerky with its taxes. So let me pull up a screen share here. Convert to being vegan works great. That means I'd have to rule out American cheese-like product. Maybe not. I mean, maybe there's no dairy in that. Maybe that's just like wax and chemicals. But maybe that's why I like it. But no, I can't be vegan. It's bacon, man. Bacon's too good. Can't get rid of that. Anyway, screen share. Where am I? Okay, here we go. So let's start with a high level. You have to understand what a capital asset is. Here's a snip right from the IRS tax topics, number 409. Just draw your attention to the highlighted stuff here. Almost everything you own and use for personal or investment purposes is a capital asset. Examples include a home, personal use items like household furnishings, or stocks and bonds held as investment. You have a capital gain if you sell the asset for more than your adjusted basis. Don't worry about adjusted basis. For now, just assume it's what you paid for it. You have a capital loss if you sell the asset for less than your adjusted basis. Losses from the sale of personal use property, such as your home or car, aren't tax deductible. So yes, you buy a car. Car's a bad example. You buy a couch for $2,000. You don't like it. A week later, you sell it for $1,000 on Craigslist to someone. You cannot deduct or write off that $1,000 loss. It's just you eat it, plain and simple. It doesn't even go on your tax return. Maybe it should. Let me not say that. Generally speaking, when people sell personal property, like I don't know, baseball cards they collected or couches or whatever, they usually don't report it. Whether or not you should is a different story, but I'm not crossing that bridge tonight. Moving on. Short or long term, and this is important for tonight's conversation. Generally, if you hold the asset for more than 1 year before you dispose of it, your capital gain or loss is long term. Note more than 1 year. It's not 1 year. It's not 12 months. It's more than 1 year. That's called long term. Anything sold within that window is called short term. For tonight's purposes, I'm really just going to be referring to like traditional investable assets, stocks, bonds, mutual funds, ETFs, and those held in like a normal brokerage account. Things held in a qualified account, like an IRA, 401k, Roth IRA, HSA, there's no tax implications to selling that. It doesn't matter what happens within the account. It's only when you take money out, it's potentially taxable. So you can buy and sell all day long. Not that I'm advocating that, but there's no tax implications of, buying something and selling it at a gain within your IRA. It doesn't matter from a current tax perspective. This is just like talking about normal brokerage accounts here. All right. It's all good. So this is what a capital asset is. And just keep in mind, it does include things like houses, your house, your car are technically capital assets. It's not just stocks, bonds, mutual funds that we typically think of, the investment assets, if you will. So how do you figure out your net capital gain or loss? So coming back to, I'm just really talking in the context of traditional brokerage assets. You will get a 1099, a consolidated 1099 from your custodian or custodians at the end of the year. It will show you all your activity. It'll report to you the taxable, the tax-worthy things, so dividends, interest, capital gains, things you bought or sold, or things you sold at a gain or a loss, how long you held it for, whether short-term, long-term, etc. That'll all be on what's called your consolidated 1099. So assuming you have that in hand, how do you figure it out? And I have an example of a tax return here. So when I mentioned Schedule D, for example, I'll show you what that actually looks like. But basically, you take all of your short-term capital gains or losses, so things you've held a year or less from the time from when you bought to when you sold them, you net them all together. Separately, you net together all of your long-term capital gains or losses. Then you net your net short-term and your net long-term. You net those two together. If it's a gain, the portion of that gain that's short-term is going to be taxed at your ordinary income rate, just like your wages, just like bank interest, just like any other normal income. But if the net gain, the portion that's long-term, capital gains, that's taxed at a favorable, reduced rate, which I'll touch on. That's the whole kind of gist of tonight's discussion. If that net figure, after you net together your net short-term transactions and your net long-term transactions, if it's a net loss for the year, you can deduct up to $3,000 of that net loss federally. Up to $3,000 you can net off against your other sources of income, be it wages, rental income, dividends, interest, whatever. You can net off with $3,000 or $1,500 if you're married and file a separate return. To the extent you have more net losses in the year than $3,000, well, then you use $3,000 to offset other income, and the remainder gets carried over to the next year, against which you can use that to offset that year's gains. Or if you have no capital activity that year, you can simply shave another $3,000 off and apply that to reduce next year's taxes, and then just keep rolling over this carryover indefinitely until it's used all up. When you die, I think it goes away. If you have a joint return, I guess your spouse gets to use it. But let's assume you're single, you have $50,000 of unused carryover capital loss. When you die, I think that's done. I don't know that I could be wrong. I'm just making this up. I don't think your estate gets to use it. It may just disappear, unfortunately. But that's an interesting thing. If someone knows the answer, feel free to chime in. So anyway, this is how you figure out what your net capital gain or loss is. And again, within that, some may be short-term, some may be long-term. We're really just focusing on the long-term stuff. Dave Myers, carried forward losses go away at death. Yeah, not cool, but thanks for confirming. All right, here's where things start to get tricky. You know how income taxes themselves, like your taxable income, is subject to progressive tax rate, this marginal tax rate structure, where any amount of taxable income you have within $0 and X amount of dollars is taxed at 10%. And then from X to Y amount of dollars is taxed at 12%, and then blah, blah, blah. That's this marginal progressive tax structure. Well, long-term capital gains have a loosely similar type of progressive stepped up marginal structure. Stick with me, but here's what the levels are. These are for 2021. So if you're single, for example, and you have up to $40,400 of taxable income, inclusive of your long-term capital gains, any portion of that $40,400 that is made up of long-term capital gains will be taxed at 0. If your total taxable income, again inclusive of long-term capital gains, is between $40,401 and $445,850, then any portion of your long-term capital gains within that range is taxed at 15%. And then same thing with 20%. So yes, to answer the question, your long-term capital gains can straddle these things. So maybe you have some long-term capital gains that fits within this $40,400 income, taxable income cutoff. Yes, that portion of long-term capital gains will be taxed at 0 federally. And then the remainder, assuming it's all within this next chunk of bracket here, will be taxed at 15% and then 20%. And then you can see for different filing statuses for married folks, it's simply just doubled. At least the 0 brackets doubled, and then it's compressed. It's not doubled for 15 and 20. Estates and trusts, super punitive. These also apply to qualified dividends. So I forget the exact definition, but qualified dividends is in effect dividends paid by U.S.-based companies, or at least companies that trade in the U.S. or something. I'm sure David Myers knows. I knew this at one point, but I forgot. In effect, it's U.S. companies that pay dividends. There's some other qualifications to it, but that's kind of the big one. If you hold that stock for a period of like 60 days around the dividend declaration date, or the date it goes ex-dividend, starts trading without the dividend, I forget. But if you own the stock long-term, basically it's a U.S. company, the dividends that it pays will almost certainly be quote-unquote qualified. Those qualified dividends are able to be taxed at these same reduced long-term capital gain tax rates, as opposed to being taxed as ordinary income. Okay. Next, and I do have an example of this to show you all how this works in my sample tax return. All right, this is important. This is a stacking concept. I know I've mentioned it. I know Dave Myers mentions it. He knows this well. I'm not ashamed to admit I ripped this graphic from kitsis.com. So for those of you who don't know, Michael Kitsis is one of the thought leaders in the financial advisory industry. Super technical, super nerdy, and I mean that as a compliment. And he writes super in-depth articles and research pieces about all kinds of really amazing stuff, technical stuff within financial planning and financial advisory. So I took this from him as opposed to recreating the wheel, because I think this does justice to this stacking idea. The only rub is that these amounts referenced are from 2019, not the 2021 I just mentioned. Yes, I could have recreated this, but this was already pretty and done, so I didn't bother. It's just be aware that these dollar amounts aren't going to jive with 2021 because these are from 2019. So, all right. Let's start with, assume you have $60,000 of gross income. We'll assume this is wages, right? So right here, there's this green bar, $60,000 gross income. Keep in mind, all these brackets I just mentioned are based on taxable income, right? Not gross income, taxable income. So taxable income, I'm dumbing this down tremendously, but it's basically just your gross income minus your standard deduction or itemized deductions if you're able to itemize, but I think less than 10% of taxpayers are. So we'll assume you do the standard deduction. So married couple in this case, $60,000 of gross income from wages minus their standard deduction of $24,400 in 2019 brings them to taxable income of $35,600. Taxable income. Again, you got that? This is important. So gross income, subtract out your deduction, takes you to your taxable income, total taxable income, $35,600. The ordinary income tax rate due on this is a total of $3,884. Again, this is 2019 levels we're talking about. What's that made up of? We'll look at this color coding. Some of that taxable income falls within what was the 10% tax bracket, which was $19,000, give or take. The remainder is in the next bracket, which was 12%. So it's taxed at 12%. Here's where capital gains stack. Assume you have what is this? $60,000 of long-term capital gains on top of your $60,000 of wages. You have another $60,000 of long-term capital gains. So after you figure out your taxable income before the capital gains are included, so again, this before was $35,600. You have $60,000 of long-term capital gains. That stacks on top of. So boom, take this, slap it on top of here. That's what this is. Okay. So now you still have the portion of this taxable income that was your wages. You still have some was taxed at the regular ordinary income tax bracket of 10%. Some was taxed at 12. You stack on your 60,000 of gross long-term capital gains. So your total now is 95,600 of taxable income. But these long-term capital gains are taxed at those 0, 15, and or 20% tax brackets, like I just showed here. They're not taxed at the regular ordinary income tax rates. So now pay attention to this gray zone, and what is this? It's some kind of weird mauve, salmon, pinkish zone. So and for married couples, the phase out of where the 0% long-term capital gain tax bracket was just shy of $80,000 in 2019. So you can see this gray zone ends at just shy of $80,000. So any portion of the long-term capital gains that fits within this 0% long-term capital gains zone is taxed at 0. So there's 0 federal income tax on this portion of the long-term capital gains. The amount above it, though, is taxed at 15%. So this additional, I can't do the math that quickly, but 16 plus $1,000 is going to be taxed at 15% tax on this portion of long-term capital gains. So you add that all up, I can't do the math that quick, but you had $3,884 of taxes due on your ordinary income, your wages. Add to that the 15% tax that's applied to this roughly $16-ish thousand of long-term capital gains. That gets you to $6,412. Is that right? That looks high. What's 15% of 16,000? 15 times. No, I guess that works. Yeah, that makes sense. maybe. Yeah. Okay. So yes. So this is the stacking concept. So again, you start with your regular ordinary income, if you will, is X. You shave off from that whatever your deduction is, standard itemized, that now drops it down. That's your taxable income. That amount of taxable income is subject to your ordinary income tax rates. That's all this stuff. Stack on top of that your long-term capital gains or your qualified dividends, because those are taxed and treated the same as long-term capital gains, like I showed in the graph before. That's the stacking. So now you look at these through the lens of where are the cutoffs for the 0% long-term capital gains tax bracket, the 15%, and then all the way up here would be the 20%. Make sense? Let's see. We have a question here. Need clarification on stacking. Example: regular taxable income of $290K. Okay. Oh, okay. Then sale of property at $400,000 gain. What percent is the 400,000 taxed at? So I'll assume this is like an investment property or second property, not your primary residence, because if it's your primary residence, you get you potentially have a gain exclusion of up to $250,000 or $500,000. So let's assume this is either net of that exclusion or not subject to that exclusion. So you have 400K to stack on top of your 290. So looking at these 2021 long-term capital gain tax rates, let's assume you're single, for example. So you're already, your 290 is well into this 15% rate. So you have another 445 minus 290, 445, 850 minus 290. So you of your $400,000 gain, you'd have $155,000 in change would be taxed at 15 because that portion of it fits within this 15. The rest spills over up into the 20% bracket. So again, you'll have about 155 taxed at 15%, and therefore about 245 taxed at 20%. Make sense? So it stacks on top of. If we were to, Mario, look at the stacking concept, just reimagine these numbers, if you will. This 0% bracket, this is more than filled up because instead of 35,000 of ordinary income, you're at 290. So you're up here. Your taxable income is well into the 15% range. So when you stack another 400,000 on top of it, sorry, I was looking at the wrong pointer. So your 290 is like up here somewhere, Mario. You're well into 15. So you stack on top of that another 400. Some of that will be taxed at 15. The remainder will be taxed at 20. So okay, so married filing joint. Then yeah, I mean same concept as what I just discussed, but the brackets are a little different. So you're still well in your 290 of normal taxable income is still well already into the 15% tax bracket. So now you'll have about 200-ish thousand of your gain, of your property sale gain, that will be taxed at 15. The remainder is going to spill into 20 and will be taxed at 20%. Federal, again. State, who knows? State, this may be taxes. This whole gain may be taxed as ordinary income, depending on your state. Oh, yes, Mark Troutman. Oh, man, I forgot to mention this. Great point. Sneaky hidden tax called the NIT, net investment income tax. It is an additional 3.8% tax that applies to passive sources of income like dividends, interest, capital gains, passive rentals, royalties, if you have some royalties, things like that. It applies for married folks if your gross income's over 250, single folks if your gross income's over 200. Any amount of passive income above those thresholds will have an additional 3.8% tax in addition to whatever the tax would normally be. So 15 or 20 plus another 3.8%. So something to keep in mind, right? I did not mention that. I should have. Thanks for bringing that up, Mark. Does income include interest income and non-qualified dividends? So if you're referring to NIT, the net investment income tax, yes, income does include interest, bank interest, dividends, both qualified and ordinary, long-term capital gains, short-term capital gains, rental income, etc. For like regular, if you weren't referring to NIT and you're referring just to, going back to here, if you're referring just to normal, ordinary income, yes, this would include bank interest, and it would include the amount of dividends you get that are non-qualified, otherwise known as ordinary dividends. Those would be lumped in this income here, which means they would flow into this. Good question. Mario, did that answer your question, Mario, about how that property will be taxed, plus the NIT to keep in mind? If you have 290,000 of income plus 400,000 of gain, NIT will apply. You are unfortunately solidly in NIT territory, Mario. All right, so that's stacking. What else do I got here? Oh, here's a question I got. Thanks, Deanne Nielsen, for emailing me this last week, I suppose it was. So this is important to know because the gain that you have, the reported gain you have, is based on the basis or cost of the position you have. And there's different ways you can choose to report your costs, depending on the position you have and how many different lots of purchases you've made and what costs they were. So there's a handful. I think I'm missing one. I am missing one. Yeah. I thought about that when I was driving in today. So the cost basis reporting methods are these. Now, some broker, I don't know if all brokers honor or offer all of these or just a subset of these, but definitely check. It's worth checking if these apply to you. So first in, first out, that just simply means the securities you bought first, assuming, let's say you've been buying a stock consistently every month, every year for 20 years. All those different purchases are at different costs. The oldest ones are almost certainly or very likely going to be the ones at the lowest cost, assuming the stock went up over time. So if you were to choose FIFO, otherwise known as first in, first out, the stocks you bought first will be the ones that you're assumed to have sold when you sell. So that means those will, all else equal, they'll have the largest gain because you're selling off the ones that had the oldest or lowest cost, lowest basis. That's FIFO. Its sibling is LIFO, last in, first out. And all the accounting nerds out there will know these terms painfully well. These are very popular terms in the accounting world. So LIFO, last in, first out, is just the opposite. Simply put, when you sell a security and assume you've had multiple purchases throughout however many years, the ones you sell are assumed to be the ones you most recently purchased. Now, maybe those will be the ones at the highest cost, maybe not, but they're the ones you most recently purchased. There's HIFO, highest cost, or I guess, I don't know, maybe HCFO, whatever. This may not be called HIFO, but you get the gist. The point is, you tell the custodian, I want to sell the securities that are the highest cost, the highest basis. So pick those. Those are the ones I'm selling first. That's HIFO. And there's LOFO, lowest cost out first, just the opposite. You tell the custodian, yeah, I have a bunch of different securities I bought throughout the year, and a bunch of the same lots of the same security, the same stock, same bond, whatever. When I sell me out of the lowest cost ones first. That means you'll have the highest reported gain when you sell those. Maybe you want that, maybe you don't. There's average cost. As the name implies, however many different lots and share prices you have, you just average those out. The ones you sell are assumed to be sold at that average cost. And there's LGUT, loss gain utilization. This is where the custodian will figure out, take it upon itself to assume you are disposing of the securities with the largest losses first, i.e. the highest gain. The highest cost in essence. Maybe this is the same as HIFO, and there's some nuances to it I'm not aware of. I'm frankly not that familiar with this loss gain utilization, but I know it exists. The gist is that, or the significance behind this is that it's assuming you want to help reduce your taxes, all else equal. So let's sell the things at the largest loss. If you don't have losses, sell things at the smallest gain, so as to not give yourself more taxable income for the year. That's loss gain utilization. The one I forgot to, yeah, so this is what Mark's saying. The one I forgot to mention was a specific lot or specific trade or specific ID. You specify, if you bought one share, every month for 5 years, for 60 months, you have 60 shares in there. You can specify which of those 60 shares you want to sell. Maybe it's the one you bought first. Maybe it's the one you bought last. Maybe it's the one you bought, 13 months into your 60-month plan. You can specify the specific lot. And you check with your custodian exactly how you report. So by default, most custodians, I think, use FIFO, first in, first out. You can generally specify when you set your account up, or if not, when you set it up after the fact, how you want the default cost basis to go when you sell stuff. Now, some custodians may let you do each time you trade, you can switch it up and say, hey, for this trade, I want to sell the lowest cost, the highest cost, first in, the last in, the loss gain utilization, the average cost, or the specific share lot. Some custodians may not allow that. I don't want to make a blanket statement so they all do or they all don't. Definitely ask to the extent this matters for you and you're trying to really carefully manage, taxes and things like that. You do have these different cost basis things at your disposal. So if you're trying to solve for something, you're trying to give yourself the most amount of gain possible because you're in a really low tax bracket, you're trying to fill up that 0% long-term capital gain tax bracket, for example, then you probably want to use lowest cost out first because that all else equal, that will give you the highest gain. And vice versa. If you want to unload something because you don't like the security or you're trying to trim down your exposure to it because you're overly concentrated and you want to minimize the taxable gain, then you would use like HIFO, the highest cost out first, because that'll result in the smallest taxable gain when you sell it. Cool. So that's it for the slides. Let me pull up the tax return thing. There's nothing too magical about it, but I thought this was kind of cool to see. Let me do this. Sorry, let me minimize this a little bit. Do this. Make this. Here we go. Hold on a moment. Switching up my screen share. All right. Yeah, I'll zoom in a little. So this is produced from my tax return software. This is a fictitious couple. They give us some dummy social security numbers. These are not real numbers. And these, I didn't come up with these names. These are one of like the template dummy returns that the tax software comes with that'll let you play around with different things. So anyway, it's Oxford and Loafer Shoemaker who live Cobbler Ave in Cincinnati. Cute names. This may actually be a Cincinnati zip code. I don't know, but don't worry. These are fake social security numbers at least. So here's what I plugged in, just super, super simple. I assume they have $90,000 of wages and a net $45,000 capital gain. So total income of $135,000. There are no other deductions or adjustments, so that their adjusted gross income is that same $135,000, against which their standard deduction is $24,800, which means their taxable income is $110,200. Now, don't freak out yet. This, if you notice, if you're sharp, look, it's their wages and their capital gains all lumped in together as part of their taxable income. Well, you said, well, Andy, you just told me that long-term capital gains are sort of split out and taxed at different rates. They are. And looking at your tax return, you wouldn't yet know or see that here. Okay, you're still going to have what's reported as taxable income, but don't worry, this isn't the not all of this is run through the normal ordinary income tax brackets. So let's just keep going. You wouldn't know that by looking at this again, but your total tax on your taxable income is $11,962. This is for 2021. The return says 2020. That's just because the 2021 form isn't available yet, but rest assured, this is 2021 numbers that this tax software is using. So the total tax for the Shoemaker family is $11,962 on taxable income of $110,200. But behind the scenes, it is calculating that some of this is taxed at long-term capital gain tax rates, some's taxed at ordinary income. Let me show you. Moving on. So here's Schedule D. This is, and I referred to this in the slides before, this is what summarizes your total short-term capital gains or losses and long-term capital gains or losses. So part one shows your short-term. You had $10,000 of sale proceeds for short-term transactions, i.e. those that you sold within in under a year of 12 months or less from when you bought them. So you sold it for $10,000, bought it for $15,000. So that's a net loss, net short-term loss of $5,000. The bottom section, part two of Schedule D, is the long-term activity. Your total long-term transactions, you had sale proceeds of $120,000 against a basis of 70,000, cost of 70,000. So you had a $50,000 net long-term capital gain. Recall I said before, you net together all of your short-term transactions, net together all of your long-term transactions, then you net those nets. So scrolling down, when you net those nets, you have a net $45,000 capital gain. And that was, no coincidence, the $45,000 capital gain that we see that was carried through on our 1040 on our tax return. But again, just by looking at this, you don't know whether it's long-term or short-term. You have to dig into the details and the supporting documents of the tax return. So Schedule D is what will show the breakout of how much was the net short-term gain or loss and how much was the net long-term gain or loss. Schedule D is fed by potentially a series of Form 8949. It's not to get too technical, but just pointing out these names so you know what they are. This is where you would actually report the transaction-specific transactions. It's like Austin Powers when he said, allow myself to introduce myself. This is where you would report the transaction-specific transactions. So I just dumbed it down and did it as one just to keep it simple. But if you had 5 trades, you would see 5 different trades here. Now, sometimes you don't have to actually produce this, but let's just assume you do to keep it easy. I just lumped it all together. So here's I had one short-term trade, bought it in 2021, sold it in 2021. Here's my 10,000 proceeds against my 15,000 basis. So here's my 5,000 loss. And then here's my long-term transactions, bought it in 2018. I'm assuming it's one trade, just to keep it simple. Sold it in 2021, hence it's long-term. It was more than 12 months, my holding period. Sale proceeds of 120, cost of 70, long-term gain of 50. All right. So now, how do you actually do the calculation? The stacking is the visualization. That pretty chart, just visualize it. That won't actually tell you how to calculate this stuff. And that's not easy to do. There is a worksheet called the Qualified Dividends and Capital Gain Tax Worksheet. I believe this is one of the attachments found in the instructions to Form 1040. If you do your tax return by hand, you will have to grind through this with pen and paper, pen or pencil, and probably an eraser. But generally speaking, use tax return software, whether it's TurboTax or you have someone do it for you. They're going to use software that's going to do all this. But point is, this worksheet is what actually calculates out the the split between how much was ordinary income, how much is long-term, short-term, etc. So I won't go through the whole thing. There's lots of numbers to look at here. But it starts with that total taxable income figure of 110,200, right? But now it starts splitting out. Okay, how much of that was long-term gains? How much of that was other income? How much of that was short-term? And it does the math. So it bifurcates or trifurcates, I guess, depending how much income you have. How much of the long-term capital gain was taxed at 0, right? So there's 14,800. Then it keeps going. Okay, how much is taxed at 15%? 4,530 is taxed at 15, etc. So all said and done, it says if you were to take that total amount of taxable income that we showed, that $110,000 inclusive of the capital gains, if you were to run all that through the ordinary normal income tax brackets, you would have gotten $15,824,000 of tax. But that's not right, because a good chunk of that should have been taxed at the reduced long-term capital gains. So now that lower amount, the amount where your normal income is taxed at the ordinary rates and the capital gains is taxed at the lower rate, that results in total tax of $11,962. So this is the figure that you ultimately see on your 1040 when it says you owe $11,962 of tax. That's where it comes from. It comes from this qualified dividends and capital gain tax worksheet. That's what figures it out. And then if you're interested, the tax return software usually dumps it down even more and will give you a little table like this that says, okay, here's where, here's the income brackets, if you will. Here's where you lied within 22 bracket. But if we were just to run all your income through the normal tax brackets, you would have had this 15,000 of tax. That's not right. Instead, using the long-term capital gains favorable rates where applicable, your total tax is only $11,962. So your total tax is that based on using the most advantageous tax method allowable for you. I'll stop there. I said a lot, showed you a lot, scrolling around a lot. So this may have lost some of you, but hopefully this made sense, and hopefully this gave more clarity into the stacking concept, because that's important to know. And then in practice, how does this actually look on a tax return? How is it actually calculated? Well, there you have it. All right, I'm done with my bit. I will take whatever questions or comments you have. I see there's only 55 watchers right now. I was expecting more. Maybe the nerdiness of this freaked people out and scared them away. Generally, these things have 100 plus followers. Anyway, question: can you use a deferred sales trust to defer taxes on securities? If so, do you have any info that you can send me on how to do that? I have no idea, to be honest. I know there's when selling rental properties, there's a DST. That's not deferred sales trust. That's a Delaware statutory trust, I think, which I don't know much about. I really don't know. I frankly never heard of a deferred sales trust. Or if I did, I heard about it in, I know of it in a different way. But regardless, I don't know the answer, and I'm not familiar with this question or concept. So if anyone else watching is aware and knows the answer, feel free to share. Thank you. Good question. Sorry, I do not know. Yeah, real estate. So definitely, there's something called the DST. Like I said, I think it's Delaware Statutory Trust. David Myers, deferred sales trust works like an installment sale. Okay, interesting. So yeah, so an installment sale, again, something else I'm not an expert on, but I know enough to be dangerous, I guess. Like when you sell a property, for example, you have a rental property and you sell it. If you sell it all outright for cash now and you realize all the proceeds of that sale now, any gain you have is taxable in that year. You can do an installment sale where you're in effect kind of making a mortgage to someone. You say, I'm selling you this property for $500,000. I bought it for 100. I'm selling it for 500. So I have 400,000 a gain, but I'm not selling it all today. We're going to enter an installment sale where you're going to pay me over time that $500,000. As you pay me, I then recognize a portion of that $400,000 gain with each installment you give me. So that's one way to sort of stretch out the taxability of the gains when you sell properties. I don't know if you can do installment sales for things like securities. Like, definitely not. I don't think when you sell them through like a normal brokerage account. If you have some sort of private arrangement where you're selling a private share of something to someone, then I guess you can do installment sale. But trading and selling, exchange traded stocks and ETFs and stuff like that, I don't know that the installment sale is even an option, to my knowledge. I can be wrong. Yeah, so when you do get an installment sale, some loosely like a mortgage, like I said, each payment you get is part return of principal or part payment of principal and part interest. That principal part is what you realize as the portion that actually goes to paying you as part of your gain. Thank you, Dave Myers. Anyone else? Questions, comments, concerns, random musings for that matter. I'm happy to hear random musings. Oh, what's this? The scary part of your presentation is I'm actually following what you're doing, having done my taxes for the last few years with TurboTax. Ain't nothing scary about that, whoever said that. Congrats to you for doing your taxes and understanding this. Some people, and it's not bad, some people just don't want to bother, don't want to know. I didn't used to for a long time until I started to actively get engaged and take more of an interest in this, years ago. I used to just have a friend of mine from high school who's been doing taxes forever, do my taxes. Eventually, I started wanting to pay more attention and get more acquainted with it and start doing it myself. And that's when I really got fascinated with all this stuff. How are ordinary dividends taxed? Ordinary dividends are taxed just like regular income, like bank interest, like your wages, like taxable pensions. It's just normal income, ordinary income. So that's why if you are a dividend investor and you invest in things specifically to throw off as much dividend as possible, you ideally want them, assuming it's in a regular brokerage account, not an IRA or whatever, because again, the taxability, that stuff doesn't matter in the year the activity happens. It just matters when you take money out. In regular brokerage world, you ideally want to try to make sure the majority of your incomes are quote unquote qualified, which means they'll be taxed at lower rates than ordinary income would. Now, again, most U.S. companies, vast majority, if not all their dividends will be qualified. REITs are an exception. REITs, real estate investment trusts, their dividends are not eligible to qualified, but currently there is a separate little tax benefit to dividends paid from REITs. They're eligible for a 20% credit called the 199A deduction. So 20% of the dividends amount you get are reduced in essence. Or is it actually tax credit? I think it's actually tax credit. Now I'm confusing myself. Either way, there is some benefit to getting dividends from REITs, even though they're not qualified dividends. Another great reason to defer Social Security until age 70, so as to have more room to do tax gain harvesting. Yes. Social Security, I think everyone knows one of the main benefits to delaying as long as possible is that when you do eventually start, the payment will be larger than otherwise would have been. The downside, obviously, is you forego receiving payments along the way, but when you do start, it's that much higher. The other benefit is in those years where you're deferring, you need to get income from somewhere, you have more control and discretion and tax planning opportunities around your income, such as taking more out of tax deferred accounts while you're in relatively low tax brackets, or doing tax gain harvesting. We've talked about this before. Tax gain harvesting is simply if you're in like a really low tax bracket, ideally the 0% capital gain tax bracket, you probably want to sell some things at a gain, realize those gains at 0% federal tax rate. And if you like the position, turn around and buy it the next day, right? You don't have to exit the position completely, but you can sell it, take some basis off the table while you can do so in a low or zero capital gains tax rate, and just quote unquote, reestablish your basis going forward by buying the position again. Good comment, Defaults. Mark Troutman, thank you. Ooh, yeah, great presentation on stacking. Thank you. Yeah, and again, kudos to Michael Kitsis for letting me steal. At least I did give full credit to his stacking thing. Very important to get that, and I thought that graphic did it justice. During the year, my custodian classifies all dividends as ordinary. After year end, they reclassify dividends to the correct category. It makes tax planning a bit tougher. Is this typical? Yeah, good question. I think it's typical. So when you get your 1099 consolidated 1099 at the end of the year, that will definitely split out ordinary dividends versus qualified. During the year, yes, I think it is common that the custodian doesn't know, I don't think, throughout the course of the year, as dividends come into your account, get paid into your account, I don't think they know from the issuing company, from the dividend paying company, whether they're qualified or not, because I believe the dividend issuing company doesn't need to report the qualification status or lack thereof until later in that year. So it is quite possible, whoever posted this, that is indeed the case. Now, for what it's worth, you can go back and look at their historical dividend payments. So like if it's a company, a single company, just picking a random US company, General Electric, for example, they're US. If you own that stock within, for that 60-day window around either the dividend X date or the payment date, I don't remember which one, it'll be qualified in your hand. So you can assume for the most part, if you're a buy and hold investor in that GE stock, all your dividends are going to be qualified from GE. Probably. I don't like speaking in absolutes. There could be exceptions, but generally speaking, all your dividends from them should be qualified. Where it gets a little different is mutual funds. You own a mutual fund that invests in a gaggle of US or maybe in some international stocks. You don't know till the end of the year how many of those dividends are qualified. The mutual fund company will eventually disclose that, but you don't know exactly. The best you can do is go off prior years and kind of use that as a proxy. If historically 90% of the dividends paid, pass through were qualified, then you can safely assume that roughly 90% of this year's dividends will be qualified as well, unless the portfolio has a markedly different strategy than what they have in the past. Then maybe the game's different, but otherwise, looking at historical years is a decent way to go about it. Okay. Anyone else? Dave Myers, installment sales. Yes, thank you. Oh man, CRTs. What? Stop. All right, I'll stick around another handful of minutes in case anyone else has any other questions. I will take off my screen share just because. Looks like that is all. Blah, blah, blah. You want an extra dad joke for the fun of it before we wrap? So you got 3. I'll give you a 4th tonight because you're special. I had a good one before. I was running these by my wife. We have very different senses of humor. She chuckled at one of them. I included that. She did not like the others. I did. So I didn't include it. But this is one I like. I hate my job. Not true, but I hate my job. All I do is crush cans all day. It's just soda pressing. Soda pressing. Get it? That's that. On that note, this went downhill fast. I will leave it there. Thank you all for joining. Next week's topic, I believe, is this one's concerning me. Next week's topic is it rental? Yes, understanding taxation of rental properties and rental income. I'm not ashamed to admit now, I am not an expert in all things rental taxation. There's frequently questions in the group about selling a rental property that I lived in the past. Recently, how's that treated? I don't know that entirely. I'm going to try to figure it out as much as I can for next week, but I will give lots of caveats next week that I don't know with certainty the answer. I do know other things. I own 2 rentals myself. I've since sold them, but I never lived in them. That complicates the matter greatly, in my opinion. But the year-to-year reporting of income and expenses, that's pretty straightforward. That I'm plenty well versed on and qualified to talk about. So, and yeah, thank you, Mark. So for those of you who were interested, I will be the Retirement Answer Man podcast from Roger Whitney. Every month, he dedicates each week's show that month to a certain topic. So he'll do 4 or 5 episodes all on the same topic. For October will be all about taxes and retirement. And so he was kind enough to invite me on to be a special guest for all 4 episodes in October about taxes and retirement. So look out for that. That'll be a fun one. Thank you, Mark, for bringing that up. And whoever this is, yes, help me study for the enrolled agent exam. Yeah, I knew much more about rentals when I studied for the EA exam. A lot of that stuff, like most of business stuff, has left my mind after doing those exams. And quite frankly, I don't want to go back to having to worry about business taxes, which is why, no coincidence, I typically do not work with folks who are business owners in my planning business, because that's just a whole layer of complexity that I know I'm not an expert in, nor do I want to be, but I at least know enough to know what I don't know, and I know where to go to get the answers. All right, I'll stop there. Thank you again. Have a good week. I will see you next time.